All right, all right. I love the energy. Hopefully we're living up to Aptos Alpha expectations. I'm Solomon Tesfaye. I'm the Chief Business Officer at Aptos. And at Aptos, of course, we have a very strong focus on RWAs, and that's really going to be the topic of today, Wall Street to wallets. I want to try to make this a little bit unique relative to a lot of other RWA panels. So just to get straight to the point, in a very paraphrased manner, why exactly are you pursuing tokenization at all?
When anyone borrows money today, you think you get your interest rate? A good chunk of that interest rate is going to pay to trace contracts to make sure when you pay your monthly bill that it goes to the right person. Like a good chunk of your interest rate on your mortgage, on your loan is that. We get rid of that. And as a result, your borrowing costs fall for everyone.
I guess I'll jump in on that as well. To that point, when you think of a structured debt product, a lot of the time, if you put all of that on chain, you decrease the settlement time to instant. You get much better transparency. You get a secondary market, and then you get increased collateral as well. So those four benefits you get when you put different products on chain that you don't with off chain, and all of that flows back to low origination costs, which is really what we're highlighting here.
Yeah, I think, you want to think about access, right? I think why Franklin Templeton decided to explore blockchains and public blockchains was to create efficiencies and discover a whole new way of doing business. When we first started out on this journey, we were just thinking about using, DLT as a means of a proof of concept, of thinking if we could even use blockchains to create efficiencies within our own business. It's about the velocity of money and enhancing, how money is moved around. And I think we're starting to see that, especially with the rise of the Genius Act, and especially how these tokenized money market funds will play a major role in kind of this new ecosystem of peer-to-peer wallets, intraday yield. What we've done at Franklin is that we've tokenized this U.S. government money market fund. As I mentioned, we're live on Aptos. We're live on 9 public blockchains. We've taken this construct of a money market fund, but we've created new efficiencies and enhanced the utilities, right? We believe these utilities are very integral to everything happening right before our eyes, especially with the new administration, and especially having everything so fluid with all these new regulatory lifts that we're seeing. So the world that we're living in, you're going to see stable coins and tokenized U.S. government money market funds work in tandem to create a whole new way of payments, settlement, collateral, funding. All will be done with both. So we're super excited about what this future is going to look like. And we're super excited about working with Solomon and his team on how to create these efficiencies for new users to join, our ecosystem.
Yeah, I think that's really exactly what it all comes down to is the efficiencies and what we can really seize on with this technology. If you think about the iceberg of global capital, for every dollar of equity that exists in the world, there are $4 or $5 of debt. And outside of the hyper liquid markets like treasuries, things either trade very thinly, trade very inefficiently, or don't trade at all. And the reason that they don't trade comes down to the data layer and the processing layer and the settlement. And the trading, it's not just the liquidity you get by being able to trade, but the efficiencies in terms of origination, servicing, and securitization that blockchain is really primed to change. Things that have been legacy workflow problems in credit for my entire career, and I know certainly long before that.
I would say, there's about $4 trillion in capital on chain today. If you look at traditional markets, there's many multiples of that. At BlackRock, we believe that tokenization has the potential to really transform capital markets. And so since part of our philosophy is always meeting our investors where they are, we are extremely excited about that potential.
Were you about to add something?
I'm just going to say the title is Wall Street to Wallets, and picking up on what Ryan said, why we're focused on credit, there's a joke on Wall Street, which is that the equity markets are a pimple on the ass of the credit markets. They're giant. It's enormous. And if we can, and so much of the initial tokenization work has been on, treasuries, some equities, and it's partly because that's what consumers know that they can invest in. So if you're trying to tap into the capital that's on chain, so many of the retail investors know what a Tesla share is. They know what a US Treasury is, so they buy it. But the real operational benefits and the real scale, the moment where your firm suddenly is all in, is when the credit markets open up, I believe.
Yes, at Aptos, we're very bullish on fixed income. Fixed income is multiples bigger than the equity markets. So same with private markets, so much bigger than the public markets. So we're really doubling down those particular use cases. So with that, when you think of just distribution when it comes to RWAs has still been modest at best. So just how are you thinking through distribution, whether it be on a primary basis or let alone on a secondary basis? Maybe we start from this side this time.
I think the one thing maybe to take a step back on in terms of like what distinguishes RWAs or tokenized assets relative to digital assets is a lot of these underlying have to follow through regulation, and that depends on regulation in different geographies. And so a lot of the issuers, such as BlackRock, need to comply with that regulation. And a lot of where we spend a lot of our time thinking about of like how to make that user, that investor experience seamless is how do we make sure that we create regulatory compliant solutions and bring them on chain.
I think one of the things that my DeFi sensei, Eric, has been trying to teach me about is in many ways the retail and retail plus Web3 native or Web3 enthusiast investor community has leapfrogged to a place where institutions have lived in TradFi in terms of their sophistication of using collateral, taking assets that they own, putting them in vaults, putting them in looping strategies, having things on deposit to trade derivatives. That's something that took a long time for TradFi to develop, and even now is really the domain of institutions. And I think building on the logical first place for these types of collateral assets, i.e. U.S. Treasuries, incrementally into other forms of safe yield products, and then also being able to tranche them out is something that really lends itself natively to tokenization in a way that TradFi offers, but largely to institutions, and hasn't really solved the problem of investor reporting or kind of portfolio management for it.
Yeah, I think it's a really exciting time when you think about distribution with these tokenized products and as more come on chain. The way we think about distribution, especially with public blockchain networks, so these unique ecosystems, there are probably going to be growing faster than some traditional ecosystems now. So tapping into these new moats, these new digital nation states, I think is super exciting. You're just thinking about that as a means of finding new entrants into distributing these new products that we think them being natively on chain matters. And we think that these products having the ability to democratize everyone throughout this globe. If you really think about it, we offer 4+% yield on our product. It has the ability to go peer-to-peer, has the ability to kind of move in a lot of different directions. But think about that from a global scale. Most people aren't earning 1% on their money. So now we are creating a way that distribution can touch a lot of different people, not just institutions. We have a retail app, we have an institutional user interface. So we just think of these new concepts of evolving. We've built, with one of the strictest regulators on the planet. We initially started our journey in 2018, thinking about how public blockchains could be used in our business. So we worked, quite extensively in the early days with the SEC. So working with the SEC to get our US Benji platform up and running has led us to have significant learnings of how to work with other strict regulators on the planet. We offer opportunities in Luxembourg with the CSSF, where we have another product that's available in BVI. We just went live in Singapore. So throughout our strict, amazing journey with working with all these regulators in the ecosystem have enabled us to develop really unique insight on how to develop products for distribution. We just need some other things to work its way through the regulatory landscape to allow us to have third-party distribution, the same way we work with traditional players out there to distribute, this tokenized money market fund natively on chain. So there's a lot of really exciting things that are continuing to be very fluid in terms of when you think about distribution, and more moving to a more wallet-based economy more than it is just now, right? You guys, crypto native, you know what a wallet is, but we need to tap into the folks that use banking apps and also need to use a app like ours and know that it works, it's being powered by blockchain. The same way you drive a car, you don't necessarily know how a blockchain works, you just know that it works the same way you use your apps. So that's how you think about some of the distribution opportunities out there.
Yeah, not much to add. The only thing I will say is obviously this technology can be transformative for distribution. I think one of the biggest challenges that we're going to still kind of hit up against is KYC, AML, and on-chain identity. And we're really not going to reach that point of providing the same level of democratized access that we're all going for until we're able to kind of solve that problem. And I'm super excited by the number of startups that are working on in the space. Galaxy is quite involved in the startup ecosystem, supporting many on-chain identity providers. And I thought I'd just flag that while I'm super excited for what the distribution can have, until we solve that and are able to make it, faster, better, cheaper for people to actually buy these assets in a compliant way, I think we're going to continue to see material challenges to broader adoption.
Yeah, I think, sorry to jump in, but I think Thomas makes a good point. We're a permission token living in a permissionless world, so finding ways to enhance this KYC element, universal passporting, or whatever it's going to look like, I think is very crucial to mass adoption on a bigger scale, right? We need to figure out how to make it easier for people to get access to these tokens. So Thomas makes a good point.
Maybe to give something slightly different, if I jump forward a few years, 5 years from now, people are just going to buy assets. The same way, like, you don't know if it's Amazon Web Services or Azure underneath your app. You're not going to know that your asset's tokenized. You're just going to say, wow, it's so cheap to buy this, and wow, it's so fast to transact, and wow, my mortgage rate just fell by 20%. This is great news. And that will be enabled by the hard work of the other panelists here and figuring out all the regulations and making it so seamless that you just buy it. But ultimately at BlackRock, when you're selecting a retirement savings account, it will be tokenized, but you won't know it. And I think that's where the distribution actually ultimately goes enormous, because then it's just every savings dollar, period.
Just to double down on that last point, so my team's probably exhausted from me using this analogy, but when NASDAQ introduced electronic trading, it took about 5 to 7 years for that to be adopted more broadly. No one says electronic trading at this point, they just say trading. So to Zander's point, it's going to be synonymous with just your normal experience when you interact with anything of value, any type of commerce of any kind. It simply will be on chain in the background.
Part of why Pact works on Aptos is the speed of Aptos and the cost of Aptos. Because we work with tens of millions of borrowers, all of whom have multiple loan repayments a month often. So we're talking about just huge volumes of transactions. And if we were working on another chain, it would be prohibitively expensive for the borrower. If we were working on another chain that was slower, they'd say, make my payment, and they'd see a loading, like the little circle of death, waiting to see if they actually had done anything. Because these are real people in their real lives. These aren't just DeFi people trying to get an extra point of yield on something. This is someone trying to send their kid to school. And it matters to them that when they make their payment, they're good. And without Aptos, we couldn't do that. And so Aptos is a step towards that world where people aren't thinking about tokenized assets. They're just thinking about assets. They're just thinking about getting a better home in a better neighborhood with a better mortgage.
In general, at Aptos, we're heavily focused on these practical applications. We call them real-world applications when it comes to remittance, microfinancing, cross-border transactions, B2B transactions that are cross-border, because that's where you see a lot of the friction at this point. Of course, we're focused on payments as well and on all these other use cases, as you saw with the tap demo a little bit earlier today. But we really try to go for immediate, real use cases that are solving real-world problems.
And correct me if I'm wrong, but, keep me honest. I think digital wallets have grown faster than the internet in the early days of the internet, right? So if we're thinking about distribution, the wallet-based economy is here because it's grown faster than the early days of the internet, or maybe the first 10 years of the internet. I don't know to be exact, but I'm pretty sure that's the stat that I'm trying to find. So think about that when we think about distribution. We're thinking about distribution on an institutional level, but the opportunity, the scale is with these retail wallets as well, which could be huge. So.
Absolutely. And so I'll throw out another question, and anybody could answer this one because it's probably quite speculative. And then also given the fact that a number of you work in regulated businesses, maybe you're limited in terms of what you could say, but how are you thinking through permissioned and permissionless interactions? In the last discussion, like the last point, we kind of alluded to it, but how do you foresee this happening? You already see with some efforts synthetic products that give indirect exposure to public equity. You already start to see derivatives that are giving access to, in certain countries, access to certain financial permission products. Kind of, does anyone have an opinion on how you think this is going to materialize? Let's go Galaxy.
I mean, I think one thing that's entertaining is, remember during the last cycle or the cycle before that, when people were talking about should a bank have a fully permissioned network versus actually joining Ethereum or the other public networks? Now everyone recognizes that we're on public chains. That's a given. And then the next step is how you come up with the environment that these institutions are willing to and excited to jump onto, knowing that they can come up with the technology to give them the compliant kind of rules and regs that they're used to with the other technological backends. And so from that perspective, it's one of those things where the market is continuing to evolve. We're still early, but that switch of figuring out how to create an environment in DeFi and across other parts of the ecosystem to have permission areas where you can actually have these type of interactions and have on-chain private credit interactions for these different types of issuers is key. And at Galaxy, it's one of the key problems that we're looking to solve, because again, we all see that end goal where we don't have to talk about tokenization anymore, and we have that distribution. But the question is how we get there. And so we're just looking for those tools that enable us to get to that next wave of adoption, and that balance between having things that are fully on chain and fully permissioned while still having the freedom of DeFi is something that we're going to have to continue to kind of navigate in the next cycle.
You're totally right that there was a first phase where institutions were trying to talk to other institutions and build permission chains. And that took quite a few years. And now that conversation is no longer, as there was a realization that we could actually focus on crypto native users and investors. We saw some early traction there. So some of the works around some of the tokenized treasury funds really solved a clear need in the market where some of those crypto native investors did not want to go off chain in order to manage their treasury and earn a yield on it. We're now evolving towards a broader range of investors on chain who are so used to being on chain that they may want other products. And this is where I think the broader RWA conversation comes in. And maybe hopefully in a few years, we'll have that phase 3 where broader institutions, more users will actually come on chain as well.
The Genius Act, which created and enabled this liquidity layer, this cash layer, with now all these stable coins being able to flow in a whole new way than ever imagined. So just thinking about that from that perspective of how this is going to enhance what we're talking about here with a lot of the tokenization efforts of all of us, that liquidity layer is huge. And that's where you're going to start to see more and more players that were never even thinking about this now making entrance into this marketplace. So that, coupled with everything else that we're discussing here, is probably one of the biggest things that I think is going to really create this huge floodgate of opportunity for these tokenized products to evolve together, right? With this whole new system that's going to be open for everyone.
And it's not always rosy, right? There's obviously friction. So we obviously don't want to be naive here. So in this safe space amongst hundreds of our closest friends, we can basically go through all of us, highlight exactly where you're experiencing the most friction as this ecosystem matures.
In a way, the more capital that is comfortable buying on chain, the more this is going to accelerate. Because the results for the borrower, in our world for the borrowers, but for the end holders of the assets, those are clear. Those benefits are just there. And so I think one of the frictions is just traditional institutional capital getting comfortable buying on chain. Because right now, the on-chain markets are deep, but as you pointed out, Thomas, the off-chain markets are significantly bigger. We want that moment to come where they're not thinking about the risk of on-chain. They're just saying, I want an asset. And lo and behold, it's better to buy it here than there.
Yeah, not to jump the row here, but I think one of the most literal friction points is also the friction points that exist in TradFi. And when you're introducing, if you were just introducing a new off-chain piece of software into a lending ecosystem, it takes time. And you need to have critical mass of adoption, and there are network effects at pretty much every layer, networks on networks. But I really do think that that's what's changed in these most recent cycles of adoption, is the technologies for end borrowers, the technologies for capital providers and capital consumers, and then investors have gotten better. But I think probably the single biggest friction point that I see in my day-to-day is incentivizing people to move as much as possible of their entire credit life cycle, from them setting up a credit box for the loans they want to make, for them thinking about how they're going to document and enforce their loans and collateral, how they're going to package that into a facility we're going to provide them and help them grow. Because we don't just want the information about the loans we've financed. We need the information about their entire business to make smart underwriting decisions. So there's a little bit of friction there. We've found almost universally that it ends up being worth it. The partners that we're working with, one of them recently thanked us just as they were refinancing our facility with a much bigger and cheaper one for kind of dragging them into that world. But I do think convincing people to put in the sweat equity of getting these tools in place, it's not just solving a problem that's a blockchain specific problem. In many ways, this is forcing them to address things that are already problems in their lending or in the life cycle of credit. And I think the difference here is that rather than just being a new loan management tool that, will become obsolete, this is actually changing fundamental things about how the data flows, how collateral is managed, how the capital flows, which is what I probably am the most excited about.
Yeah, I think when you think of friction too, you got to think of more and more legacy systems as they start to build on chain and go on chain. That's how we're going to reduce friction, right? You have legacy players, and we're just talking about finance legacy players for the most part, these institutions that are thinking about how do we incorporate our business more natively on chain. When all those players start to enter the stage more than they are now, whether it's next year and years to come, that's when you're going to see the friction really reduce. Like when we, as Franklin Templeton, we really thought about our business in a way of, we're Franklin Templeton, we're a large asset manager, we've made our business over the last 75 years through mutual fund growth and built our business on mutual funds. What are mutual funds? They're a system of ledgers. So for us to think about all this made perfect sense to use blockchain. So we really thought of this in like a bigger picture. We also thought about legacy, transforming a legacy transfer agent, which we had 40 plus years of operating at Franklin Templeton, and how to look at using just a digital transfer agent instead of a legacy transfer agent. So I think large actors in this space need to start thinking more natively in their own business, and that's how, natively on chain, of how we're going to reduce friction when we're all kind of using the same systems and all these systems are working synonymously on chain throughout the entire ecosystem. So we'll get there.
To that end, I think a lot of getting there is simply education. I think even I've been at Galaxy for 2.5 years at this point, and when I started, a lot of it was Galaxy reaching out to TradFi saying, hey, you should think about, hey, this is, ballpark, this is the difference between a Bitcoin and Ethereum, like very, very high level. And even in the past 2 years, not only is it TradFi coming to us because they recognize us as a unique player in the space that can, has the DNA of traditional finance, but the expertise of DeFi, it means that increasingly the level of sophistication and the conversations that we're having with some of the biggest traditional financial institutions on the planet are so much more sophisticated and so much more farther along that it means that the adoption curve, I think, is just so much faster than we anticipate, because once they get comfortable with it and once we have the regulation and once we have the technology, it really just does have that S curve. And I think that's one of the biggest kind of hindrances today, is simply just educating the decision makers at the leadership level so that you can have more Larry Finks of the world who, really drive and recognize the opportunity for their, major traditional financial players to really jump in.
I also, sorry, it's just because I think this is a really important one. I really feel like we are at a point in time when a lot of traditional finance has gotten to that education point where they have to start asking themselves the hard questions. A lot of the arrogant perspective that people, including maybe even myself on certain days in the past, might have had around, Web3. Like, we've had two very major, very public issues in the credit markets in First Brands and Tricolor, where collateral that was supposed to be there just straight up was not. And in one case, it was automobiles, which between VINs and titles and insurance, I don't even know how that happens. It happened because these are just spreadsheets and PDFs that get sent around. It should not be that hard to convince people who just got burned there that an actual self-executing contract that confirms that VIN is not pledged somewhere else would have just saved them several $1 billion.
I think maybe just to summarize, because I echo a lot of the points here, I think there's really two opportunities. The first is around compliance, KYC. It's you want to onboard users and investors faster than today, and you want to enable the transfer of tokens of those regulated RWAs. I think the second one is education, and we still have some ways to go, but I think one of the really helpful catalysts are, for example, IBIT and ETFs in Bitcoin and Ether. I think we're almost at 100 billion for IBIT, and this really has catapulted the momentum in terms of the conversations we're having with institutions that are now much more active in the space and wanting to understand what they should be doing in the space. And so I think that's a really positive for the industry as a whole.
Yeah, the final thing I'd add is once operating costs, I believe, once the operating costs are shown, once it's just cheaper and safer and faster, the market will catch up. It may take a little bit. The regulations will have to change. You'll have to overcome some inertia. But no one's going to leave those savings on the floor. We've done the first end-to-end stablecoin syndication of a full credit facility. Fingers crossed, we'll do the first end-to-end securitization stablecoin transaction. And then once it's actually happened, we're just going to walk everywhere, and as will all of you, and say, look, it worked. Would you like this? And all the barriers will quickly be surmounted once all those savings are available to people, I believe. Tell me if I'm wrong.
No, I agree. I was going to piggyback off what you said. I was just going to say we're in a unique, interesting kind of spot, right? I view tokenization and I view the rise of ETFs 30 years ago, very similar kind of ways of ETFs enabled cost-efficient ways of getting access to various products and strategies that were just built different, right? So this is kind of very interesting parallels of tokenization, and the same way ETFs revolutionized asset managers' business and TradFi players to where they are now, this is what's going to happen with tokenization, is where Zander mentioned or faster, quicker, right? That's what this is all about, but making it in a way that can enhance, cheaper, right? Look, Franklin Templeton, when we initially launched our journey, when we were showcasing of using a legacy transfer agent, let's just say costs $1 per transaction, we've witnessed the powers of using a digital transfer agent and not running a digital twin to showcase that it costs like $1 to run 50,000 transactions. So do the math. So that's what you really need to think about here at a bigger scale from cost perspectives. And we witnessed this power back in 2021. So that's real. The cost savings are real. And more institutions understanding the power of blockchain and enhancing your business through these powers will create amazing efficiency gains for everyone.
And one thing for the sort of DeFi purists out there and the sort of blockchain purists out there, this may sound institutional and this may sound kind of clean cut, and we're talking about OpEx. So many of these benefits are actually coming from the philosophy that so many of you pushed over the last 10, close to 20 years, like the lack of knowing where the VINs were on Tricolor and on these others. The solution was that if you distributed that information and made it accessible to many, suddenly it was harder to commit that fraud. Like the core philosophies that some of you out there have been pushing so well are fully inherent here.
And just to double click on that, right, represented here, we have everything from, of course, the BlackRocks, the Franklin Templetons, the Galaxies of the world, but then we have businesses that didn't even really exist a year ago that are killing it and putting 1.9 billion of microfinancing loans on chain. So to your point, we have the full standard deviation of companies represented here. Final point, or final question rather, and we'll have to go quick because this is the only blockchain conference in the history of blockchain conferences that is actually running on time, is a quick, basically, prediction 5+ years out.
No one is talking about tokenization 5 years from now. No one. Because it's just assets.
I was going to say, I hope that my title, head of tokenization, doesn't exist at these firms because the back end just is on chain and no one has to think about it anymore.
5 years from now, we'll all be on Mars. Just kidding. Look, I think I'll just say, I'm not going to make a prediction, but I think for us to really get this moving forward in a quicker direction is to all of us collectively to figure out the KYC component to make products that are on chain easier, quicker for access for everyone, right? So passporting needs to be a lot easier into these products.
5 years from now, the bottom 4/5 of that iceberg, all of those credit assets are going to be processed massively more efficiently than they are today. And that's something that most of us don't see, but will change how finance, both on-chain and off-chain, works.
Maybe a call to action then. We need more users on chain, whether those are institutions or retail. And so for all the builders to continue building easier ways to access blockchain, I think is key.
And then on my side, Aptos will be synonymous with value movement, value trading. Thank you, everyone.
Thank you.
Thank you.
We appreciate it.